Hey there, future millionaires. Ever dream of money working for you, even while you sleep? That's the beauty of passive income, and dividends are a fantastic way to tap into it. We're talking about owning a piece of a company that pays you just for being a shareholder. It's like getting thank you checks in the mail, quarter after quarter, just for being a loyal investor. Dividends are more than just nice-to-haves. They can be powerful engines of wealth creation. Imagine your investments compounding over time, not just from stock price increases, but also from regular dividend payments. That's the magic of compounding in action, folks. Whether you're just starting out or you're a seasoned investor, understanding dividends is crucial. It's about taking control of your financial future and building a portfolio that generates a steady stream of income. So buckle up and get ready to dive into the exciting world of dividends. Let's break down this dividend thing, shall we? In simplest terms, a dividend is a portion of a company's profits that it chooses to distribute to its shareholders. Think of it as a reward for investing in their success. Companies announce their dividends on a per-share basis. For example, a company might declare a $1 dividend per share. If you own 100 shares, you'll receive a cool $100. Not bad, right? Now, not all companies pay dividends. Some prefer to reinvest all their profits back into the business for growth. Others, especially well-established companies with steady earnings, often share a portion of their profits with investors as dividends. It's a way for them to attract and reward long-term shareholders. When it comes to reliable dividend payers, blue-chip stocks are the all-stars. These are shares of large, well-established, and financially sound companies with a long history of profitability and dividend payments. Think of companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These giants have been around for decades, weathering economic storms and consistently rewarding shareholders with dividends. Why do blue-chip companies love paying dividends? It's a sign of their financial strength and stability. It tells investors, hey, we're doing well and we want to share the success with you. Now, let's talk numbers. A key metric to understand when evaluating dividend stocks is the dividend yield. This tells you how much dividend income you can expect to receive annually, relative to the stock price. Calculating the dividend yield is simpler than you might think. You divide the annual dividend per share by the current stock price and then multiply by 100 to express it as a percentage. Dividend yield = annual dividend per share, current stock price, x 100. Let's say company XYZ pays an annual dividend of $2 per share and its stock is currently trading at $50. The dividend yield would be 2/50, x 100 = 4%. This means that for every $100 you invest in company XYZ, you can expect to receive $4 in dividend income each year. Not too shabby for simply owning a piece of the company. Section 5. Navigating dividend dates, a timeline. Investing in dividend stocks isn't just about picking the right companies. It's also about understanding the timeline of dividend payments. There are a few key dates to keep in mind. First, there's the declaration date. This is when the company's board of directors announces the dividend amount and the payment date. Then, there's the ex-dividend date. This is crucial. To receive the upcoming dividend, you need to buy the stock before the ex-dividend date. After the ex-dividend date comes the record date. This is when the company determines which shareholders are eligible to receive the dividend. Finally, there's the payment date, the day you've been waiting for. This is when the dividend is actually paid out to shareholders. Section 6. High yield versus dividend growth, finding your fit. Not all dividend stocks are created equal. There are two main types to consider: high-yield stocks and dividend growth stocks. High-yield stocks, as the name suggests, offer high dividend yields, often above the market average. These can be tempting for income-focused investors. However, high yields sometimes signal underlying problems within a company. Always do your due diligence. Dividend growth stocks, on the other hand, are all about increasing their dividends over time. These companies are often in growth industries and prioritize returning value to shareholders through consistent dividend hikes. They are the marathon runners of the dividend world. Section 7. Building your dividend powerhouse, a strategic approach. Ready to build your own dividend portfolio? Diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors and industries. Consider including a mix of high-yield stocks for immediate income and dividend growth stocks for long-term growth potential. Look for companies with a history of consistent dividend payments and a solid track record of profitability. Remember, building a dividend portfolio is a marathon, not a sprint. Reinvest those dividends. Let the power of compounding work its magic, and watch your passive income stream grow over time. Section 8. Dividend traps, avoiding investment pitfalls. While dividends can be a powerful tool for building wealth, it's essential to be aware of potential pitfalls, particularly dividend traps. One red flag is an unusually high dividend yield. While tempting, this could indicate that the company is struggling and may be forced to cut its dividend in the future. Another warning sign is a high dividend payout ratio. This measures the percentage of earnings a company pays out as dividends. A payout ratio consistently above 100% is unsustainable and could lead to a dividend cut. Section 9. Choosing wisely, identifying reliable dividend stocks. So, how do you avoid dividend traps and choose reliable dividend payers? Start by looking beyond the dividend yield. Focus on companies with a strong track record of profitability, a healthy balance sheet, and a history of consistent dividend payments. Research the company's industry and competitive landscape. Are they well positioned for future growth? Do they have a sustainable competitive advantage? These factors contribute to long-term dividend sustainability. Remember, investing in dividend stocks is about finding companies you believe in, companies with a solid foundation and a commitment to rewarding their shareholders over the long haul. Section 10. Embracing the dividend advantage, a call to action. Congratulations, you've made it. You're now well equipped with the knowledge to navigate the exciting world of dividend investing. Remember, dividends can be a powerful tool for generating passive income and building long-term wealth. Start by researching companies that align with your investment goals. Look for those with a history of consistent dividend payments, strong financials, and a positive outlook for the future. Don't be afraid to start small and gradually build your dividend portfolio over time. Reinvest those dividends and let the power of compounding work its magic. Remember, investing is a journey, not a destination. Stay informed, stay curious, and most importantly, stay bullish on your financial future. If you found this video helpful, please like, subscribe, and share it with others.